Well, thank you. The Federal Reserve today hiked its benchmark interest rate for the fourth time this year by 1/4% to 2.5%. Fed Chair Jerome Powell has a tricky task in trying to reassure markets that the economy is strong enough to take another rate hike, while at the same time not tipping it into recession. And he's been drawing fire from the man who appointed him, President Trump, who has attacked the Fed on Twitter for raising rates and triggering a stock market sell-off. And just yesterday, former Fed Chair Alan Greenspan unnerved investors when he declared the bull market all but over.
It would be very surprising to see it sort of stabilize here and then take off again. But it's happened in the past. However, at the end of that one, run for cover.
Joining us to share their insights on the economy, the markets, and the outlook for 2019 are Susan Schmidt, head of U.S. Equities at asset manager Aviva Investors, and Marc Horner, founder and financial advisor at Fairhaven Wealth Management. Welcome back, both of you, to Chicago tonight. So, Susan, Alan Greenspan delivers that point of view from the mountaintop, and what happened?
Yes, well, that is not the first time we've heard some of the investors in the market, pundits say that, we're ready for things to collapse. We've been in this recovery for a long time, and there's been a long upward trend. So almost everyone is prepared for this to start slowing down. The question is when. And we'll hear that phrase peak earnings a lot. Have we passed the peak? Is this as good as it can get? And I think that's where investors start to panic if we take that, because they assume it's a roller coaster ride, that it's immediately going to be a precipitous drop. That's not necessarily the case. And unfortunately, Greenspan's use of words might imply that roller coaster ride that isn't necessarily the path forward.
So, Marc, run for cover. Right. Run for cover. Now, that's not a sort of tranquil way to explain what you ought to do.
It's not, and neither is irrational exuberance, which is the other phrase that he's famous for. And I think a lot of people forget the timing of that statement that he made, which was in 1996. So 2+ years before a turn actually happened in that market. And I think I think that just goes to evaluating track records of Wall Street prognosticators. They're generally not that good. And so a lot of attention today is being paid to the Fed minutes. For me, the more interesting document from the Fed was back in 2017, where a report was published where they reviewed their own accuracy of forecasts and gave themselves a horrible record. Or rating, rather.
A flunking grade?
They did, and the trend was not positive. They actually said the accuracy of their forecasts, whether that be economic growth, interest rate forecasts in the future, is actually trending down since 2008. So I think there's a lot of hoopla that goes around the announcement of Fed speak. But I really think for individual investors, it's important to put recent market activity in context and really focus on issues that they can control, and the Fed is not one of them.
So was it a good decision by the Fed today?
It's too soon to tell. These are things that we don't know how this is going to affect the economy until we look back in 6 months and reassess. And I think what the Fed did was largely expected by the market. The market was predicting that there would be a 25 bip, 1/4% increase to rates. So that wasn't the surprise. The surprise to the market was that I think they were really looking for more reassurance in the tone and the comments afterwards that the Fed would be there to support the economy. We're raising rates now in an environment that suddenly has headwinds, whereas when we looked at this at the beginning of 2018, we had tailwinds. And so this is changing the perspective of the market, and that volatility has brought nervousness back to the investor.
There is a take on this, however, that what the Fed did today was a demonstration that it was not going to be bullied by the president who disapproves of this. That would assume that they pay attention to his Twitter feed and to politics, which we heard the Fed chairman say absolutely doesn't happen. Does it, Marc?
I don't know that it does. President Powell at the Fed. So actually, President Obama originally introduced him into the Fed system, and then President Trump appointed him as president. I think he's a I don't know him personally, but looking at his resume, he's a seasoned business person, and I think I think regardless of where one falls politically in terms of how you feel about President Trump, I think it's fair to say that he can behave a bit like a loose cannon. And my strong inclination is that Chairman Powell is not paying a whole lot of attention to 2 in the morning tweets.
But the consumer is paying attention to the stock market, and the stock market today had another dismal down day. Both of you talk to investors all the time. So what do you say to them?
So I think that goes back to context, to putting what we're experiencing in the market in context. So the stock market does not move up in a straight line. You know, numbers of average annual returns of 9 to 10% are, I think most people are familiar with. What a lot of people are not familiar with is that what we've gone through just recently, these last 3 months, this is pretty normal. Going back to 1980, there has been a move from the top during a calendar year, the move from a top in the stock market to the bottom on average of about 14% down in every single calendar year going back to 1980. So while what we've experienced over the last 2 or 3 months, it's been more dramatic than it usually is. It's pretty normal in the context of investing.
It's new because we haven't felt it since the recovery. So we are at correction levels now. We're down 10% from the highs in our major indices, but the market isn't used to this kind of volatility. We've had a very long, extended, multi-year period of low volatility. So to see this bounce back, in historic context, it's not that extreme, but relative to recent years, it is. And people aren't used to it. We have a very emotional market that's perhaps helped along by some emotional tweets that come out around the market. And at the same time, we're at a tough position and point of the economic cycle. So CEOs are coming out talking about earnings, talking about pressures ahead. We're seeing a different tone from them, and all of that is leading to cautiousness. I think the phrase from most investors, professional investors today, is, "I just want the year to end." So we really have a tough period right now with no news, and that's the danger. Until we get into 2019, we're in a news vacuum. So be prepared. There's going to be more volatility because there's nothing really for the market to grab onto as a hard, cold fact.
So one of the hard, cold facts is about unemployment. While unemployment is down, wage growth is not up. Mm-hmm. And so there is that whole question of whether that constitutes growth, even though we're told that the economy has grown. For a lot of people, when you use the word recovery, Susan, there is still an awful lot of people in the middle class and the lower middle class that don't know what a recovery even looks like to this day. So what do we make of the unemployment situation and the wage situation?
Well, I think when you talk about recovery, let's talk about the consumer for a second and talk about consumer confidence. Consumer confidence is incredibly high, and that gives me a lot of comfort that the grassroots economy is still feeling pretty good. Consumer confidence is high. Small businesses feel good about what they're doing. They want to invest in the business, and we are seeing people who feel very confident in quitting a job and moving to another one because there's an opportunity for them. At the same time, we do have an issue in that how is wage growth impacting things? We're seeing right now, I think, a good position for the consumer coming into the holiday season where gas prices are down, the consumer seems to be continuing to spend, and we're looking at that confidence level very closely at Aviva Investors to make sure that we understand how that's tracking. Unemployment, that number is difficult because there are a lot of moving components to it. Demographics play a huge part, and while it's low, I'm not sure that that data captures all of the current situation.
Well, so I completely agree that the wage growth has not been what it should be, has not matched the economic growth. For me, I think that goes back to accessibility of education. The data is overwhelming that the more people move up the educational experience level, that earnings follow. And so I would love to see our political leaders do something about making education more broadly affordable for all and accessible. I think if an educated workforce is just naturally going to be more productive, both for their employers but also for themselves.
When it comes to President Trump's tax cuts, where do we see that in terms of what it has produced in the economy, or do we see something?
I think it might be a little early to judge that. I have seen some estimates that maybe in 2019 the tax cuts could account for as much as 2% of additional GDP growth, so economic growth. But I think it's a little too soon.
Well, and that's hard to judge because we're coming up against a very tough comp, and we talk about tailwinds in 2018 that caused this rise in the markets. The tax cuts were a big part of that. So seeing that reduced tax level, businesses were more profitable, that then inspired an increase in the share prices. And we don't really know, again, the economy, it takes a long time for things to play out. So is that really going to contribute to growth longer term? We won't know for a multi-year period,
and
really.
going back to that previous discussion, will it contribute to wage growth? Will that be a pass-through from employers to employees? We still haven't really seen that.
We haven't. We saw some initially when the tax cuts were announced. There was an immediate increase in announcements of minimum wage, benefits, bonuses for employees, and that seems to be a one-time thing. Some of those wages where the base wage was increased have stayed at that higher level, but we haven't seen more announcements like that. And one of the things that the Fed is looking at is inflation, and increasing wages is part of what drives inflation. So it's a tricky balancing act right now.
So a Christmas message for your investors, if you could summarize it in a kind of Hallmark card greeting, would be, Mark?
Well, that's a challenge. I would say control the controllables and try to ignore the rest. And so specifically, maybe what somebody could start doing tomorrow morning is to look at their portfolio and make sure that they don't have any unnecessary tax obligations waiting for them. So we're working hard on that with our clients to make sure portfolios are tax optimized. And then if you've been staying up at night with recent market volatility, it's always a good time to re-review your financial plan and make sure your portfolio's appropriately positioned.
A little longer than a Hallmark card.
I don't think that fit on a card.
It's a little bit longer.
But it's a heartfelt wish. Listen, both of you, thank you very much, and may your holidays be wonderful.
Thank you.
And yours.